episode of Gossip Finance. I'm Alicia Singer.
And I'm Duncan Sandlin. And today's show, we're going to talk about investing. Fun stuff. Yeah. So,
what investing you want to talk about, Duncan?
Well, so there are two factors to investing: risk and return. And return's everybody's favorite part, but risk is actually the more important part to investing. So we're going to focus mostly on risk today and how it relates. But we're going to go ahead and I'm going to start with a little PowerPoint, and then we're going to jump into some videos from the Money Guy and Dave Ramsey and stuff.
But all right, so Duncan, I'm starting way back at the beginning and telling us what risk is.
I'm doing that right now.
All right.
So risk is what'll affect the return of an investment, right? It's what can cause it to lose money or gain money going forward, especially in the financial term. You know, risk can be lots of different things, but in finance, that's what we're talking about. The two basic types of risk are systematic risk and unsystematic. So systematic risk is the market. The market goes up and down. It affects, returns, right? So anything that's affected by the market directly would be a systematic risk. Unsystematic risk would be everything that's unspecified that the market doesn't necessarily directly affect. Okay? And that affects a couple different things. So that could be the type of business you're in, right? So I'll give you a great example. I live in Portland, Oregon, and Nike headquarters is here, and Adidas American headquarters is here. And recently, if you've been watching the news, Adidas, hang on a second. Adidas had this problem with Kanye West, who's their spokesperson. And Kanye West got in trouble for saying a lot of anti-Semitic things repeatedly on different platforms and interviews. Very, very anti-Semitic stuff. So Adidas had to cut him. Now that's going to affect their sales, their stock price, their bottom line, right? But it's not going to affect Nike. So that would be a good example of a business risk, because it's going to affect Adidas, but it's not going to affect Nike, even though they're in pretty much the same business. So that would be a direct business risk. Then there's risks like creditor default risk, which would be your chance of not being able to pay your debts. That could affect individuals or businesses, right? Country risk, which country are you in, right? So if I'm selling thong bikinis, I'd probably do really well in Brazil, but not so well in Saudi Arabia. So that would be a country risk. Foreign exchange risk would be if I'm selling in a different country with a different currency, like if I'm selling in Russia for the ruble right now, the ruble's worth nothing. I'm going to take a bath trying to exchange it for dollars. So that would be a foreign exchange. Interest rates, kind of what's going on now with the Federal Exchange raising interest rates. This directly affects banks, but it affects kind of everything. But it's the rate you can borrow money at or lend money at, or money can be traded at. Political risks, things like laws change. It could affect a business or an individual. Counterparty risk is the idea that people you have contracts with might renege on the contract or not fulfill the contract, essentially. And liquidity risk is basically you can't afford to pay for your needs at the time. So those would be the basic types of risks that you would see in a market. Now, did you have any points on that, or?
No, I don't think so.
Okay. So those are the basic risks. Some of them are individual, and some of them are just business, but they can all sort of be applied. To give an example, we did actually this one yesterday. I'll give this one real quick, of systematic risk in a market. So I have two couples here, couple one and couple two, and they both invested in the market. So the S&P 500 returns, which measures the market, and they both had $150,000 to invest at the top.
Mm-hmm.
Now, couple one started investing in 2006, which would be year one here. And I took the market returns for each year going forward. But they withdrew $12,000 a year because they needed to supplement income, right? Well, as they went through time, the first early years here, they took a lot of losses. Things didn't go so great. And by the end of their 17 years, they were out of money. They were 12,000 of the whole.
Mm-hmm.
Couple two on the other side of that coin, I took the year 2022, this year, and I did it in reverse and worked it back to year 17 is 2006. So same returns, just in the backwards order, right? And couple two also had 150, took out 12, but since they had better earlier years versus the bad later years, they ended up having $144,000 left in their investment as opposed to couple one who was end up in the hole.
Okay, so tell us again what the risk part of that is, because we're zooming in on risk.
Right. So the risk part of that is, what is the market doing at the time you invested it? Right. So the markets go up and down, and people will tell you, well, it's got a standard return of 10 or 8 or whatever, however you want to measure it. But the bottom line is it's when you started investing versus when you started pulling out. Right. So if I invest when the market's high and I pull out when it's lower, I've lost money.
Mm-hmm.
If I invest when it's lower and I pull out when it's higher, I've made money. It's the old adage, buy low, sell high. Right. So if I start and the market goes down, instantly it takes me longer to make up the money I lost than it does for me to make money and then lose it and make it back.
Mm-hmm.
Right. So if I start with $100 and I lose 10%, and then one year, then I'm down to 90, and I gain 10% the next year, I'm only up to 99. I still haven't made back to where I started. So I have to make a higher percentage the following year. So so losing money eats away more, right? And that's a risk factor in systematic risk. And I just did the little graphs here to show you couple one and two. And couple one is the orange line here, and they basically ran out of money early on. As for couple two, saw growth early on, and then when the bad years hit, it didn't really affect them as badly because they were already in good shape. I mean, they still got tagged pretty hard, but they were in a better position when it happened.
And then it's systematic risk because it very simply is what the market is doing.
Right. It's the risk related to investing in the market.
Right.
To how the market reacts. So let's do, real quick, I'm going to do these guys. The Money Show guys. What's the guy's name? Brian Preston here on the left. And his co-host is Bo Hansen. No, it's like the Dukes of Hazzard. Anyway, they're going to talk a little bit about investment advice. We're going to start out with
this. You had to pump on him making that face.
Yeah, I know. Wasn't my choice. It just happened that way.
But I'm sure it was accidental. It was just, people only freeze on Zoom making weird faces. Right?
I know. Isn't that always how it goes?
Right.
All right.
So they have to say.
Yeah. So, real quick, yeah. So,
okay. So what is this a clip about? We're about.
Okay. So this is the Money Guy show, and they're going to talk about investing advice that they're giving, just general kind of investing advice.
A general sort of.
Yeah, and these guys are both certified financial planners and chartered financial analysts. They have a pretty good idea what they're talking. They know what they're talking about, but they're not going to get into what the risks are or why these things are bad. So we're going to take what they say and then we're going to elaborate a little bit.
All right, let's do it.
All right.
Old school one, because I use this all the time. Everybody used to go to get Money Magazine, Kiplinger's, or other things, and they would have the best performing funds of this year, or the best performing stocks of this year. And everybody run out and go grab those funds. And you look back and you'd be like, man, this thing just did not do well. They had one good idea in 2007. They had one good idea in 2014. You have to be very careful looking solely at past performance, because there's nothing that ties into what we just talked about previously. When we understand the valuation, understand dividend yield, understand earnings. It's much more than just how did it do last year? They might have gotten lucky. So those are all the bad influences.
So he makes a good point here. So there's a risk where they're talking about, okay, I picked something because it was really good last year. Okay,
How many times do people do this?
All the time, because they're just focusing on return.
Right.
They're not focusing on the risk, because the risk can change, right? Twitter was a good investment last year, 2 years ago. It has not been a good investment this year since Elon Musk took over, and now there's all this speculation it's going to be worse since he fired like half the people there, and he's changing their whole format.
Right.
So
You remember, it's not only systematic. It's not only what the market is doing. There are other types of risks that need to be evaluated,
and business risk. Maybe you have, maybe you have a. I'm sorry. Yeah, business risk. Maybe you have a crazy CEO now. If Captain Ahab's running the ship, then things might go bad, right?
Maybe they come in, they make a whole bunch of changes that are not changes that actually are good for the business, and everything goes down.
Right. So that's the speculation. So there's more risk now associated with Twitter than there was last year because of this buyout.
His hand is moving very fast.
Yes, it is. So now this next clip is going to be, they're going to talk about another idea of discipline in investing.
It's kind of amateur when you think that you can just go pick, this great stock and do it. The next one is timing the market. That's very much a lack of discipline thing.
Yeah. And so even if you're someone, you listen, you go, okay, guys, I got this. I'm into this show. I just went and analyzed the price-to-earnings ratio for every one of my holdings, and man, it's profit. I'm going to cash. I appreciate you guys helping. I'm going to cash. You might find that you get yourself in trouble because it's not that easy to move in and out of it, And so a lot of folks who this happen all the time, they try to time it. They try to get really cute with it, where a lot of winning the game is just being in the game.
Yeah.
So another good point.
Yeah, we could use a little bit of clarification. I kind of wish he had explained a little bit more on that.
So basically they're talking about what I was just saying. Talking about things, I thought things were bad, so I just sold. Right? But then when they started to go back up, I bought, but now I missed all the gains. Right? This is what's called opportunity cost.
All right, let's talk about that.
Because this is important.
Opportunity cost. Because that's where the real decision making comes into play here,
Right.
Trying to figure it out.
So we'll get back to this slide later, but I want to focus on this first point. So it's basically just loss of the potential benefit from an alternative option, right? And the simple calculation for it is your opportunity cost is the best foregone option, right? The best option that could have happened, right? Versus what you chose. You just subtract it, and that's what you lost. So
the best case scenario minus what I really did.
Yeah, and we'll get into ROI and IRR later, but we'll come back to this slide in a minute. But essentially, so let's say, for example, Alasius comes to me and she says, I have a business opportunity. I need to borrow, $1 million. And this is what the cash payouts will be to you over the next 5 years, right? What I would do is I would do this thing called the capital asset pricing model, which is the most common thing that most people do, where I would sit there and go, okay, well, if I invested it in something similar to what Lacey's proposing, right, and I compare them together, or I compare it to, say, the market even, what is the return I should be expecting versus what is Lacey's promising me, right? Now, if the number turns out that, look, if I invest it in this, I'm going to do better than what Alasius is going to give me, potential return, right, with a little bit of risk I can factor in there, then that doesn't make sense. It's not, the numbers aren't sexy enough, right? Mm-hmm. Now, on the other side of the coin, Alasius could say, well, this is what I expect to be able to do for sure, but if this works out, potentially it'll be even more money. It'll be double what I'm saying, right? And I say, well, I'm not willing to take that risk. And then Alasius gets the money from somebody else. And sure enough, she gets the cut.
I do exactly what I said I was going to do.
Right. So that would be my opportunity cost, right? Because I took the other option, right?
And the best option was actually the thing I presented you.
Right.
So we have to see how that turned out and subtract out what you did.
Right. But the problem is there's no way to really know that at the time. So you have to be concerning about that. But that's what you have to realize, too, is there's always going to be a risk no matter what I choose, right? If I choose to do nothing, there's a risk because I'm not gaining anything, right? So I'm losing that opportunity to gain. So no matter what you choose, you're taking a risk. So once you get that in your head, it's not so daunting to sit there and go, okay, well, maybe this risk isn't as bad. But a lot of times people think, well, if I do nothing, there's no risk. It's no, because if you do nothing, you're losing all the opportunity cost.
Right. And you can really actually evaluate, the difference between any other option that would have paid you more than having your money parked in your savings account.
Right.
I mean, even just what the market did minus what your savings account did.
Right. So this, yeah. So just what they're talking about. I panicked because the market looked volatile or it looked bad at the time, right? So I sold, and then when the market came back, I lost money. So to further prove this is an important concept. Let me see if I can get this over here now. Since nothing is working. Our high budget show.
Duncan, we're color coordinated today. It's almost like we had a costume designer.
Yeah, thank you.
Or wardrobe department. I like costume designer better, though. I think
it sounds sexier.
It sounds sexy. Once we have a budget, we're gonna have a costume designer.
There you go. Makeup and hair and all that. So this is just this S&P 500. Okay. So right now we're just looking at 5 years. Okay. So you can see it goes up and down. It fluctuates. Right. But if we're looking at let's look at this moment here. Can you see where my mouse is, where the lines are crossing, where it dips really bad? So this was COVID. Right. There was a big market crash.
Probably the famous COVID March-ish moment.
Yeah, mid-March crash. And then the government stepped in and invested, what was it, like $1 trillion in treasuries to fluff up the market, which brought it back so that this crash didn't last very long. It lasted a few months, right? That would be political risk, see? But political risk in our favor, where the government stepped in to change the outcome of the market, right?
Hold on. Pause right there, Duncan,
Sure.
on that thought, because I want to point out what you just said.
Yeah.
You just said risk to the positive, and I think it's important to pause and zoom in on that point again, because we think of risk as money lost,
Right.
particularly, right? Like I think human nature is to think about that in a negative sense, but you just brought it up
in a positive, right? Good point. So risk, because it goes both ways, right? Because I could bet against the market, in which case that crash would have been great for me until the government stepped in, right? With the political risk by actually stepping in. But if I'm in the market and the government steps in, the political risk that changed the outcome would have actually been in my favor. So risk and return have an odd relationship. Typically, the general rule is more risk, more return. It's not always true, but if you want to get higher returns, you generally have to take higher risk. What you don't want to do is get something that's lower return for a higher risk, which is why it's important to do things like calculate it. Like Lacey's investment might be higher risk. So if the return is less than something that's lower risk, why would I take that? That would be insane, right? Why would I take higher risk to get less money? I should get paid for the risk I'm taking, right? And if the risk turns out that it works, then yeah, that was a positive risk for me. If it doesn't, then it's a negative risk for me. But you won't know until it actually happens. So in that case, yeah, that would be what's a positive risk. The key thing to understand with this is here's a theory called random walk, okay? So if you're investing in the market, and they were talking about discipline of just keep investing, the theory of random walk is, markets go up and down, right? Everything goes up and down over time. But over a long enough period of time, everything goes up. Progress is always upwards. It's not a straight line. It goes up and down, right? But it's generally upwards, right? So let's look at the maximum here for the market. Let's see if it'll do it for me. Oh, that's not right. Let's see if it'll do this. There we go. So this is the S&P 500 back to the 40s. Okay? As you can see, it's gone up and down pretty dramatically over time. But it always trends to go up. Right? And this goes all the way to today. See, up and down, up and down, up and down, but it always trends towards the up. Right? My favorite analogy of this was a friend of mine in grad school, and he used to tell this story when he'd explain it, and when he was teaching it, was imagine there's a blind guy with a seeing eye dog at the bar, and he gets really drunk. And he's trying to get home at the end of the night, but he's really trashed. He doesn't know where he is. So he's trusting the dog to do it. And since he's not really directing the dog or commanding the dog is going to go over here or maybe sniff a tree or go pee on a hydrant or, and it might take him a little out of the way, but eventually the dog will get him home because the dog can find the house, right? The dog will smell it, right? But that's random walk. It's basically the idea that the market is basically the blind drunk guy and the dog is just the fact that, yeah, business will generally go forward. It just doesn't do it in any sort of practical sense. It just sort of does it over time.
All right.
So
I like your blind drunk guy analogy.
I wish I could take credit. It wasn't mine, but it's a good sense. So when they talk about just discipline and investing, you just keep investing and waiting and you've got enough time, it's eventually going to go up. That's just the theory. The next side of it was, you could say the market will just go away or crash or whatever completely. You could guess the world's going to end, and eventually you'd be right. The smart money is not on tomorrow. And furthermore, if the market does go away, we're fighting over food and water at that point. So you've got bigger problems than your retirement fund.
That's just one among many at that point.
Yeah. All right, so let's go. Let's skip ahead a little bit because I want to do this last little bit.
These funds. I chose everything that had the word growth in it.
Hang on, let me go back a sec. There you go.
When I was like, okay, I see something here. I said, how did you choose these funds? She goes, I chose everything that had the word growth in it. I want my money to grow.
So he's talking about a woman when he's talking to her about her account. She's picked all these funds, and she picked everything that just...
In it? Is that what he's saying?
Yeah, the word growth. So she picked all these funds that were growth funds.
I kept not hearing the word. I thought it was group. I was like just looking for companies with the word group in it. I was not catching that.
Yeah, he was not. It took me a couple times, but that's why I'm positive. So he's talking about the woman just picked everything that had growth in it.
Retirement. So I chose everything that had growth in the title. And I was like, you realize all 6 of these funds probably buy the exact same holdings. They're all closet S&P 500 funds, essentially. So she had no idea that she truly didn't have any diversification because she thought having 6 different funds with 6 different names with 6 different versions of saying growth was giving her diversification. No. So you need to understand that what does your...
Okay. So that's another good point in risk. So if I pick 6 things that are practically identical, right, I haven't improved my risk because they all pretty much have the same risk.
Right, you've replicated it.
Yeah. I could have just picked one and been pretty much in the same position, right?
Right.
So there's an idea called diversification where what I'm doing is I'm picking different things that have different risks, different returns, right, that behave differently. And the idea is that if I do that, if one makes money, one will lose some money. But if that one loses money, that'll make money. And over time, I'm consistently making more money, right? They don't go into this. Diversification gets thrown around a lot, and it kind of gets misused.
I'm feeling like we might need to do an episode specifically on trying to define diversification.
I'm going to do a quick 2-minute thing here. I'm not going to go into like the math behind it. I'm just going to do a quick concept. So there was this guy in the 50s named Markowitz, and he developed this thing called efficient market theory and this thing called the efficiency frontier.
Right.
And then a guy named Fama and French came along. So they've all got Nobel Prizes for this. So the idea is, don't focus on the straight line. Focus on this curve. Okay? So these little yellow dots are individual assets, right? And on the vertical here is the expected return, right? We don't know for sure what the returns will be, but this is sort of what we would expect, right? The bottom line is standard deviation. That's the risk we're calculating, right? So this is risk. This is the horizontal. So we're assuming this yellow dot here, for example, has this one here, this first one here, has this much risk for that much return, right? But this yellow dot up into the left of it has a higher expected return for a lower risk, so it would be a better investment. The idea behind proper diversification is if you mix enough of these together, and everything underneath this curve would be the entire markets, all the markets. If you mix them properly and diversify it properly, you should get somewhere on this curve, which is the best expected return you can expect to get for the least amount of risk. That is the concept behind proper diversification. The quick example of this, and this is a market portfolio versus a portfolio I built years ago. So person one is the market portfolio. Person two is in my portfolio. Okay. So this is the market return for 10 years. My return was different for 10 years. In fact, it was a little bit less because my standard deviation, my risk, was half that of the market. So the market's was 20.09, mine was 10.05. So what that means is, and we'll get into standard deviation more later, if the median return or the average return is 5%, right? The market return in a normal year could be anywhere between 20% above that, so 25%, or 20% below that, -15. Mine, on the other hand, I'd squeeze the risk down to a 10% distribution on either side. So at a 5% same mean, right? Mine could go from any year between probably 15 to -5, right? So it didn't have necessarily the high ends, but it didn't have the problems with the low ends. And as we discussed earlier, it's harder to make up money once you've lost it than it is to preserve money going forward. So if you look at the basic return on $1,000 was all I did, just to throw this in there. My portfolio at the end of 10 years had 1,756, but the market return portfolio only had 1,509. Even though it was getting larger returns, it was also getting lower returns in the lower market, in the down markets. So I didn't have to make up as much money over time. So the average return on that portfolio was 4.2, as where mine was 5.79. We both had the same average return, right, of a 6.25. And the beta is just how they fluctuate together, and I'll get into that a little bit more later. But you see, just by squeezing down the risk over a long period of time, by squeezing down the risk and diversifying, I can beat the market, but I need a long period of time to do it. Diversification does not work in the short run. You need 5, 10, 20, 30 years. And if you do it properly, you can always consistently beat the market over the long run. That's why these guys won Nobel Prizes for this theory, because it works. And it's pretty much always worked. I mean, there's very few situations where it hasn't. So that's the general concept behind diversification. But like he said, if everything is a growth fund, right, then you're not diversified because you basically got 6 of the same things, like he said. When you want to have probably in like my portfolios, you want to have at least 30 or 40 different things that are doing different things to hedge each other out. But essentially, that's what a financial analyst is doing is when they're creating a portfolio. Is they're looking for how do I squeeze down the standard deviation risk. So I'll just show this real quick. So this is just the graph of the two. So the person 1 was the market, and person 2 is my diversified market portfolio. So as you can see, they had larger down dips than I did. So mine had a much more consistent growth because I didn't have to make up losses as frequently.
Mm-hmm.
Does that make sense, or is that trying to keep it?
No. I think that's clear. I think we could zoom in on diversification in a future episode, but I think for the sort of quick tutorial version, that's good.
Yeah. So now that we've done that, let's jump into. Oh, okay. Here we go. I'm gonna
What do you have?
go past. So this is Stephan. Now, Stephan, I guess he's a wealthy real estate guy in his early 30s. I guess he became a millionaire in his 20s. He's a huge Dave fan. This is the guy that has the cardboard cutout of Dave Ramsey in his house.
Oh.
Takes pictures of it. So him and his buddy are interviewing Dave Ramsey and George Camel, or Skippy, as we like to call him. And they're asking about risk in return to debt. And we're going to analyze this because it's a little wonky. Not wonky, hinky, I think is probably the better term.
You would say debt is bad because for the average person, that is a good principle to live by. And with that, I kind of agree with you. However, if people do utilize debt in an effective way, such as Graham, very responsible, very well researched on the markets and how he can leverage his money with that, do you think that that is a more effective way to grow fast if you're calculated with it?
It is a more effective way to grow fast, if that's your goal. But what people leave out of the discussion is that you've increased your risk exponentially. More debt equals more risk, period. And so, after I went broke, I had to analyze and go, okay, what went wrong here? And because I had never lost money on a flip. I was not behind on the notes. They just called them. They had the ability to do that because it was commercial paper. It wasn't traditional mortgages. It was 90-day paper. And so, what it amounted to was, so I had proven track record of making money. I mean, I did. I probably owned 2,000 pieces of real estate in my life. And so I was doing a lot of flips. And some of them I was doing in 24 hours. I just buy them and flip them to another investor and make 10 grand and keep walking, that kind of stuff. So I was doing 100% finance. I didn't put any money in it. I didn't have any money. I talked a guy into giving me a 100% deal on this house. I flipped it. I made 10 grand. And I talked him into doing it again. Then I talked him into doing it again. Then I talked him into doing $1 million too. And with that one bank. And yeah, so it set me up. And so after I crashed, I kind of.
Okay. So a couple things here. There are risks associated with debt. Debt in and of itself is not more risk. Sometimes it's actually smarter to have the debt than it is to not. I'll give you a great example. You're starting a business, okay? And you need to loan, say, $100,000 to start the business, and you get a loan from the bank. So you get 10 or 11% interest, whatever, and you're paying off the loan every month, and it's a 7-year loan, whatever. Now, let's say the business goes under, right? Now, you can then bankrupt the business, right? And the loan, most of the small business loans like that are secured by the federal government, so the bank's not really out. They're covered, right? The feds lose some money, but the feds plan on losing that money. That's why they put that program together. But now you don't owe that $100,000 anymore. However, if I'd have done it the reverse way and put my own $100,000 into the business and it tanked, I'm out that $100,000. So I actually took more risk by putting my own money in. Debt in and of itself is the reason you're paying interest on it is the bank is sharing that risk with you.
Right.
The lender is sharing the risk of the investment. So actually debt in and of itself it's a way to lessen the risk because somebody else is sharing it with you.
Right.
So this idea that debt in and of itself is risk, debt kind of, it can be if you're over leveraged, if you have too much debt.
It doesn't necessarily have to be.
No, the concept behind it is it's supposed to minimize your risk. But it gets misused. And if it's misused, then, right, like we said before, credit risk was one of the unsystematic risks. If I have too much debt and I can't pay it, that's a big problem, right? Which is what happened to Dave, is he took too much debt. To give you a little history lesson on kind of what happened here. So that it was the Competitive Equality Banking Act of '87 that kind of nailed him. And this is sort of what happened. So back in the '80s, and you could only pull this off if you were a wealthy white person and male. Sorry, there's no way you'd have walked into a bank as a woman, Lacey, and they'd have given you a 90-day loan on a house.
So I would have been shut out of that whole thing too.
Yeah, especially in Tennessee where they live, you probably wouldn't be allowed to get a checking account or a credit card back in '87, back in those states. So yeah, and especially if you were like a minority, it wasn't going to happen. So it was mostly these banks that were kind of smaller institutions, or they were like savings and loan or credit institutions where they made a lot of their money on mortgages. So what they would do is, let's say I'm a young realtor, like a white guy like Dave in my 20s, and mom and dad are realtors and they have a lot of money, right? So the banks know them. So the managers know them. The owners of the bank know them, whatever. And I walk in and I want to borrow some money to flip a house, right? So they give me a 90-day loan for, say, $50,000 to buy this house that I'm going to flip, right? They give me the money. I buy the house with the money. I turn around and try and sell it as quickly as possible. And like Dave was saying, he could do it, pretty quick, right? And make 10, 20 grand here, whatever. And he kept doing that and doing that and doing that. But he never put any of his own money into it. And he got to the point where he was doing it so much that he's got $1.2 million over that in loans, in these short-term loans, right? That his business wasn't even worth that. He couldn't cover that. So that's what he filed. When they called in the loans, he filed for bankruptcy. The reason they called in the loans is because the government came in and they did the Competitive Equality Banking Act of I think that's what it was called, of '87. It's CEBA or whatever. Anyway, the reason they did that is because of this. There were a couple things. One is there was a lot of sketchy interloans between banks. There was a lot of like handshake kind of under the table loans and stuff that weren't regulated, kind of like the stuff Dave was getting, right? And furthermore, since banks make a lot of their money on mortgages, right, and especially on rents from mortgages, right, there's what happened a lot in the '80s and especially in the '70s. You're the young white guy realtor, right? I'm the bank. I know you. I know your parents. Blah, blah, blah. I have some properties in this area of town. Let's say it's a lower income, primarily black populated area of town. And the real estate's good, but the problem is that it's all lower income people, right? But I would like to make it higher income people of, I don't know, say a different color scheme. I would say, Lacey, I'll give you a 90-day note to buy this property that this family's selling. So you go buy it and then turn around and try and sell it for more. So now what have you done? You've driven up the cost of that house. So you've driven up the cost in the neighborhood. And the more and more you do that, you keep driving up the cost. It drives up the rents to the point where people can't afford it and they get evicted. And now I can move in and gentrify the area and make millions. So the idea was to try and push black people off their properties. by driving up cost. I'm not saying Dave was doing that. I'm just saying, as an
It was that time frame.
well, that's
Not
he was flipping houses. I'm not saying he had a motive like that.
right.
I'm just saying, as an ex-cop, there's enough reasonable suspicion to investigate, right? That there's something's going on here, because he's a young guy in his early mid 20s, and the banks are giving him $1.2 million in loans to flip these properties for 90 days unsecured. And then what happened is when they passed that act, these smaller banks got bought out and absorbed into more regulated banks, right? And they came in and said, well, wait a minute, this guy has 1.2 million in loans, but he's not even worth that. So we're going to call in the loans. That's too high risk. He's over leveraged. We're not doing this anymore. And that's what happened to him. And that's why he went bankrupt. He won't tell you that whole story, but that's what happened. But it was, yeah, they could get away with it. It was legal back then when he was doing it, but it was very questionable on whether or not it was ethical. And I just,
There's probably a lot of people that were doing that, hence they had to do something about it anyway.
all right, so we'll dive back in here with Dave.
I had to go through a CSI, an autopsy. You go, okay, why did the patient die? And so because everything I grew up in.
First off, CSI is crime scene investigation. It's not an autopsy. They're different things. Just to be nitpicky.
When you're in the real estate business as a profession, one of the rules is they take your risk meter out and they sit on the table and they break it. So you have no ability to perceive risk because everything's good, everything's going up, and it always works. And the mythology that just because something worked once, it's always going to work every time. So I had to go through kind of a healing of my heart in that regard. And go, oh, this is risk. Wait a minute, OPM, other people's money. Yeah, it's kind of got a get rich quick slimy vibe to it, and all that. But there are people that more intelligently than that, use debt, and so there's a spectrum there. But even those are taking on risk. And so when you have, Buffett says, when the tide goes out, you can tell who's skinny dipping. So when you stress test with an economic problem of some kind, outside variable or inside variable, inside your organization or your life, inside your portfolio, or the economy, like a quarantine type thing comes up, or inflation.
Hang on one second. Go ahead.
So, yeah, what he said, just bothers me because, in the earlier segment where we're, going through risk and debt and their relationship with each other, he just, said again that that if you're taking out debt, you are taking on more risk. But you just talked about sharing the risk, and that's not necessarily the case. I mean, it can be, but it's not necessarily the case that means that you are taking on more risk, because actually, if you just put all of your own money into it, if I put my entire personal savings into this thing and it doesn't work out, my whole life savings is gone.
Right. It's about are you calculating the amount of risk or the amount of debt versus what you make, right? So if I owe $10,000 a month in debt and I'm only making $5,000 a month, yeah, I've overexposed. I'm at risk. But if I'm making $100,000 a year and my debt is $10,000 or $100,000 a month and my debt is $10,000 a month, then it's 10%. And it might actually be worth it to me to not put my money at risk, right? And he misinterprets the Warren Buffett statement. The Warren Buffett statement about, well, the tide goes out, you can see who's skinny dipping. The point is, yeah, if you've taken on too much risk, you're basically naked in the water. But if you're wearing shorts and a bikini or whatever, the tide goes out, you're fine. Right? That was the joke about that. So Warren Buffett's talking about being over leveraged, not about debt being a risk as a thing just in and of itself. So it's just a misunderstanding of what it is. But we're going to go into this because he gets into a couple weird statements here.
Test your theories. You can tell who's skinny dipping when the tide goes out, and if your theories don't last. And so the only one I've ever found And this comes back to my faith journeys where it started. The borrower is slave to the lender. I can find nowhere in Scripture that debt was used to bless people. And so then I got to think, okay,
Yeah, if you're using scripture to measure your risk, then I don't know what to tell you.
okay, do I believe that or do I believe my academic training? I've got a degree in finance. I know how to run an IRR, and I know what the IRR looks like with debt and without debt, and it's not nearly as good unless you're leveraged. But you can run an IRR through the roof with leverage. Guess what's left out of the IRR calculation? There's no math inserted for risk. The IRR.
Okay, that's not true. Okay. The last little math lecture for us. I'm not going to do math. I'm just going to give you how the equation works.
Just give us the rundown.
So here are the basic measures, some of the basic measures of risk. Okay. Alpha is number one. Alpha is just your return versus your benchmark or the market, right?
So my return versus the market.
Yeah. So the return of the investment you're looking at, right?
Sure.
Versus either the market or another benchmark, something I'm comparing it to. Okay. Beta is the correlation. Okay. So if we're comparing to the market, right? The market would have a beta of 1. Okay. So it'd be multiplied by 1. If the comparing thing I'm comparing, the correlation, or not the correlation, but at least the relationship was 1.5 on the beta, well, that would mean for every 1% the market goes up, this would go up 1.5. Roughly, right? We're looking at some sort of historical values of fluctuation, right? If it's a 0.5 beta, for every 1 the market would go up, it'd go up half. Okay, so beta is it's a measurement of risk usually used for like business or project investments. Like our earlier example of you need $1 million and you want me to invest and you expect X return, right? What I would do is go, okay, what is the alpha, the expected return versus the market, right? What's the beta, right? Your risk factor versus the market, right? Are you going to fluctuate more than the market or less? Or whatever benchmark I'm comparing to. We're just using the market for now. Okay. This is, beta is a good tool for that kind of stuff. For stocks, not so much, because it's very short term. It's very short lived, right? And it can change at any minute, right? It doesn't have a good historical correlation. I'll show you that in a second. The third factor of risk on this is what's called R squared. This is just old statistics stuff, right? Basically, it's saying what's the causal link between the market fluctuations and the fluctuation of the investment, right? So what it's saying is, are beta and alpha, does fluctuations in the market have a causal relationship to these things? Okay. To simplify that in terms is this. If the market fluctuates a lot, right, but Lacey's business doesn't, right? Or if the market goes up and Lacey's business goes down, but the market goes down and Lacey's all of a sudden shoots up, or Lacey's moves erratically compared, then there's no relationship between your business and the market.
Right.
Right?
There just might not be one.
Right. So the beta is now useless. Okay. Now, when he brought up calculating IRR and ROI, I put this under opportunity cost, but it's just a concept. So ROI is return on investment. IRR is the internal rate of return. These are related in what I talked about, the capital asset pricing model, if I'm making a comparison, right? Now, these are going to show you kind of what is the expected rate of return, right? Or the return I'm expecting. The other thing is what he says, well, debt isn't factored in. Well, these are the debt risks that are calculated. So when I do the IRR, I'm also going to calculate other risk relationships. So I'm going to look at your debt to capital, right? So I'm going to take your total debt divided by the amount of capital you have, the amount of money. Debt to equity, how much shares do you have outstanding, right? Debt to, what was it, interest coverage. Can you cover the interest on your debt, right? Degree of combined leverage. Well, what's your leverage combined versus what you can afford, right? And are you at higher risk? So this idea, he said, calculating the IRR, risk is never factored in. It is factored into the IRR through beta, but that's not going to tell you a ton about the debt. You got to look at these other factors. So I'm calculating the return based on whatever calculatable risk I have with beta. And then I'm going, well, wait a second. Okay, well, that's good. But Lacey has $20 million in debt. And she's right. And her monthly payment on her debt is like $300,000. But her business is only making $450, and her operating costs are $150. So how does anybody get paid? Right. But if I look at it, I go, okay, well, wait a minute. Lacey's got $1 million in debt, and her debt payments or whatever, $20,000 a month, but she's making $290,000 a month. Well, now this is not such a big deal. This is a low risk. Your debt's not a big issue for me. In fact, your debt makes it more attractive. Right? Because you have a lot more room to get more debt if you need to expand quicker if things go really well, which means I'd make more money on my investment.
Right.
So there's other factors in here, right? So this idea that it's not factored in or anything, or that University of Tennessee might want to call him and say we want our degree back, because
Or that debt in and of itself translates into risk is not necessarily entirely accurate. Like, you've got to give it context.
Right. The context
is absolutely critical.
It's imperative, right?
Yeah.
What kind of debt? How much debt? How much are you making? Right? In fact, if you were zero debt and you were throwing all your cash payments at it, all your money at it, I'd be sitting there going, well, that's eating away at your shareholder return, which is going to piss off your shareholders, which means people might start bailing out, which puts you at a higher risk of mismanagement, which is a business risk. Right? So there are these things all interplay. They're not like one doesn't affect the other. I mean, it's not like they exist in a vacuum, right?
Risk. It doesn't recognize it. And so
go back real quick.
And doesn't recognize it.
All right, hang on, let me go back 1 second.
There's no math inserted for risk. The IRR is agnostic to risk. It doesn't recognize it. And so while you see this great,
which is not true because beta's in there.
Return, there's zero risk shown up in there. The chance that you lose the thing, or the chance that the stress brings on your life, or what it does to your marriage, or what it does to your bodies to carry around the weight of that. None of that is parlayed into there. And real estate is unique in that way.
Those are good points, though. I mean, if somebody doesn't understand the risk and it's affecting their personal life, then you need to factor that in, right? And maybe doing the stupid thing is better for them personally. It does happen.
Why? Because other investment vehicles teach us to mathematically insert risk. For instance, to mutual funds, you would never compare an aggressive growth stock mutual fund with a growth in income. Okay, and if you look at the chart, the growth in income is kind of like this, and the aggressive growth is like this, right?
I don't know why you wouldn't compare them, but okay.
And that's the risk factor. And the highs and lows on that, y'all probably know this is called.
That's not the risk factor, but okay.
For our audience at home, the change, the rapid change, is measured by a thing called a beta, and a beta.
But knows that beta is the measure of risk for stocks, which it is typically not. You can use it, beta number 2, as a proxy for risk on stock investments, but they're short-lived, and I'll show you that in a second. Typically, what you use is this. It's called standard deviation. If we go back to our efficiency portfolio, right, the efficiency frontier here from Markowitz, standard deviation is what they're using for risk. That's how they measure risk on stock investments. The Sharpe ratio is also used that. So standard deviation, like I said before, it's the fluctuation from the mean, from the average, right? Sharp ratio is just that return minus the risk-free rate divided by the standard deviation. But any sort of measurement you're going to use on a stock is going to factor in standard deviation in some form. And to give you an example of beta versus standard deviation, I found a fun one here. So this is Lithium Americas Corp, LAC. Okay, so lithium, they make lithium for batteries and stuff like that. Okay, which is important for like electric cars, solar panels, things like that. So if we look at this, the green is LAC's return over the last 5 years. Okay, in the market. This blue line here is the S&P 500. So our market return, right? If you look from 2018 over here to about July of 2020, the blue line and the green line move pretty much identically. Do you see that, Lace?
Mm-hmm.
So at this point, the beta would probably be about 1, right? LAC moves pretty much similar to the market, and most of its movements can be explained by the market's movements, right?
But now tell us what's going on over here in this more recent time frame here, because it sure looks like it gets a lot bigger.
Right. Well, what happened is a lot of countries in Europe and now the United States are saying we're moving to entirely electric car fleets. So we need lithium batteries for these cars. So LAC got a bunch of contracts to make these batteries over the next 15 years. Right? And this is fluctuation is them getting the contract, maybe not getting a contract, getting a contract, maybe not getting the other contract, getting another contract. So it's gone up. So now, if you were going back to July of 2020, the beta is probably about 1, and the R squared is probably really high. There is a causal relationship between these two, right? But after that, it's completely random to the market. So they measure the 5-year beta for this LAC at 1.5, but it's worthless because it moves completely random against the market. Because it's being affected more by its business risk than systematic risk. Right? So using beta to measure risk on an investment is insane. You can use it on short-term kind of stuff, but if you're using it on anything realistic, it doesn't mean anything if the R squared is for nothing, which is the case here. Right? So what would you use? Standard deviation. I would look at the mean, the average mean, and look at standard deviation and how it's changed over time to give me the volatility of the actual investment. So standard deviation, I could use Sharp or I could use historical volatility, but I have to have standard deviation plugged in order to determine that. And it's important to understand that factor going forward that Dave doesn't seem to get. He seems to think, he doesn't understand, okay, beta, you typically use it for investment projects. Lacius is doing an investment project, wants $1 million, wants me to invest. I would use beta, and I would use capital asset pricing and R squared, and I'd figure out, okay, what do I think my return is going to be? And then I would look at, okay, well, what are the other risk factors? Her debt risk factors, business risk factors, and ask myself, is it worth it compared to something comparable? Right?
Mm-hmm.
And that's how I would make that decision. LAC, I'm sorry, this is a little wonky, but I calculated this pretty quickly. So GSPC is the S&P 500 on the top here. So its standard deviation is about 1.4% over, what did I do just for the last few days? Or no, I did it for the last year, sorry. But it's been up and down, but it's been about a 1% standard deviation per year. So it's been pretty tight, right? But it's had a negative return of 19.73%. Okay. As where LAC has a standard deviation of 4.99, its beta is 1.5. So it should only be 1.5 times this 1.47, right? If it were correlated, right? If the R square was high. this standard deviation should only be close to about 2.5, 2.25, but instead it's more than double that, and its year return is over 80% because they got all these contracts. So the beta doesn't tell you anything on that investment, right? The standard deviation does, and the change in standard deviation plus the direction, but you also have to go in and factor, well, what are the business risks? Do they get the contract? Do they not get the contract? That's going to affect the stock a lot more than the beta. The beta is not going to affect that at all because it's not correlated at all.
Right.
So, did you want to do this last one real quick and then wrap up?
Let's do it.
Let's do it. So, Lacey and I haven't seen this, but we'll do, once again, cage
This
match.
one's blind. Yeah, this is a blind cage match.
Blind cage match. We're doing it. All right. So, we're going to see Dave Ramsey.
Commentary. We'll see. We'll see if I know what he's going to say.
All right. Cage match time.
Robin's in Los Angeles. Hey, Robin, how are you?
Oh, good, Dave. Thanks for taking my call.
Sure. What's up?
Well, I sold a large house and bought a smaller house. And in the process of doing that, I talked to my CPA and also my financial planner about the best way to handle the dollars that were coming in from the larger house. And they said, well, you're obviously going to have enough to pay off the smaller house if that's what you want to do. But because you're getting a good return on your invested portfolio, maybe what you should do is put the money in the portfolio, continue to service the mortgage, and have a few percent left over after that. And they both thought that was a good idea. It sounds good on paper, but I want to do it.
But something's bothering you about it.
Well, I just want to do it.
Okay.
We have the money, and we have more money than to pay off the mortgage. That's not a problem.
So let me ask you this: if the house was paid for,
Yeah.
and you met with your financial planner, and he said, "I want you to go get a mortgage so that you can invest more with me, so you can make the spread," would you do that?
No.
What's the difference?
All right. So what's the difference? What's the difference? What's the risk, Grace? What's his move? What's he gonna do? What's Dave gonna do? So the guy bought a smaller house. He's got the excess cash from the sale of the bigger house, right? I guess we're ignoring tax. I don't know what the taxes are. Maybe he got away with it.
Well, we're not done that we know that. We'll
Yeah.
we'll set that aside for the moment because we don't know.
His financial planner's saying, well, you could pay off the house, or you could probably do better if you invest. What's Dave going to do?
We have two options here on the table. What will Dave do? Okay, so Dave is going to tell him, obviously, that he should pay off the house.
Probably.
And then he is probably going to say, once you pay off the house, that you're going to take the equivalent to the mortgage payment. You're going to invest that every month in good growth stock mutual funds.
Mm-hmm. Well, but
which would be his thing.
Remember now, there's no mortgage payment because this is excess money.
What he will say is
the mortgage payment on the new house, right?
Yes.
Got it. Okay.
The mortgage payment on the new smaller house,
right?
Because that's what he would otherwise be on the hook for. So Dave will tell him to take what that amount is monthly and invest that.
Okay.
So that's going to be the basic advice. And where this relates to risk, because we're talking risk today, is that Dave is going to suggest that there, I don't know if he'll say it directly, but his idea will be that there is less risk, in his opinion, in paying off the house.
Mm-hmm. Okay.
That'll be his perception. However, I would be surprised. I mean, he might make a comment about risk, but I don't know if he'll go into his perception of risk. But I'm telling you, that's how I was looking at it.
Okay. So his argument here now is, well, if it was the mortgage broker saying, turn around and put it in the mortgage, would you trust him? Right. Because he's right. The
Right.
financial advisor stands to make more money if he invests the money, but it's
Right.
really not that much more money when you break it down. I'm just telling you, there's a financial planner like that is making probably 1% a year on the assets under management. So if it's $100,000, it's an extra $1,000 a year to the financial planner. It's not a big boost. I'm just saying. So
Arguably, you do that enough times with enough people, and
Sure.
I mean that will stack up.
right, which is probably what the financial planner is just saying. You can do it either way. I don't care.
Right.
But he's going to make it sound sinister. I'm sure.
Hello?
Oh,
What's the difference? What's the difference?
I guess there is no difference.
There's not. And so you would pay off this mortgage today. You know why? Because when I ask you that in reverse, rather than the way you're asking me about it, in other words, you're asking like the house is paid off, would you go borrow on it, or should you pay it off? It's the same math, exactly. But when I ask it in reverse, it causes you to think not only with your mind where you do math, but with your heart where you do risk. Your financial planner and your CPA are using a naive, primitive financial formula that is inaccurate because it leaves out risk.
Primitive.
Yeah.
Risk.
So he did say something about risk. Yeah.
It's calculated.
We haven't gotten to what his plan for the guy is yet, so we don't know if I'm 100% winged here at the moment. But it was right that he kind of vaguely mentioned the risk thing.
It's calculated in your heart, Lacey. In your heart, deep in the cockles, of your heart, deep down in that.
I think that makes a lot of sense to me, actually, because there's some weird buttons getting pushed in my heart sometimes, and like weird mathy things start happening. So I might have a financial calculator for a heart.
There you go. I do think it's funny that he's saying the CPA is not calculating risk because he's an accountant. That's not his problem. But the financial advisor is definitely calculating what the risk is, right? And it's when he says the math is the same both ways, it's not. But let's see what he finishes up with here. But yeah,
we gotta see if I'm in the win category here.
Well, because a minute ago he was saying, he was told not to calculate risk, and then he's saying, well, you calculate risk with beta, but he doesn't know what beta really does. I don't know where he's going, and now he's calculating risk with his heart. I just feel it, right? I feel it in my balls. That's how I know it's risky.
We are not calculating risk in your body parts.
As the chicken said, I felt it in my nuggets.
We're probably using Dave's heart than your man parts.
Yeah. Well.
And you and I, having common sense, know that their mortgages, even though it's a small mortgage, has a certain amount of risk associated with it, and they have not mathematically adjusted for that risk. And so I'm of the opinion that the borrower is slave to the lender 100% of the time.
And he hung up. Okay.
Part of the time. And I've done detailed research here at Ramsey Solutions, and we found that 100% of the foreclosures occur on a home with a mortgage. There's risk associated with it.
I got nothing to that.
100% of foreclosures happen on a home with a mortgage. You know why, Lacey? It's because you can't foreclose on a home without a mortgage. If you own the home outright, you're not foreclosing. How do you foreclose? You don't owe anything.
Foreclosure is conducted by the entity holding the loan. If there's no loan, there's no foreclosure. Yeah, I mean,
Lacey, like Dave, I'm a very scientific guy, and I've done a lot of research. And you know what I've determined? 100% of gun deaths involve a firearm. Mm-hmm.
You learned it here first, kids.
100% of drowning deaths involve liquid.
Are we gonna see his last little bit here?
We could do it, yeah.
He's just telling this guy what to do because he's kind of gone on these sort of kind of interesting tangents to listen to, but he's gone on these tangents and not actually finished.
No, I know, but it's just so stupid. I mean,
Yes. And so I don't borrow money to invest. And not paying off debt in order to keep investments is exactly the same equation. So I disagree passionately with the primitive, naive, horrible financial formula that your financial planner and CPA are using. I would pay off this mortgage in 20 seconds.
Okay.
Okay, well, I'm going to put this in the win column. He kind of cut himself off almost before finishing giving the guy the answer. So I don't think he did a great job of finishing his own answer. The only part he didn't do is he didn't tack on the and then go and invest the difference. But
well, no, and I did the calculation real quick. So had the guy paid off the loan, I figured a 15-year mortgage. Okay.
Yeah, that's what he. Well, that's what Dave would have told him to get.
Yeah. Well, I figured 15 years. I gave him 5%. I figured, okay, if he paid off the loan, he'd have saved $45,000 in interest payments, and then he'd have been able to have saved with I did 10% return rate, $306,000. So interest plus what he saved, he'd be at $351,000. Okay, in the positive. If he'd have taken, I figured $100,000 just to keep it simple. To start with, if he takes the $100,000 and he just invests it at 10% over 15 years, he'd have made $418,000. So he'd have been $67,000 in the positive. So let's look at what kind of risk are we talking about here? Are we talking about opportunity cost? Because his best foregone option would have been to invest it at 418 minus his current chosen option of paying off the house, where he'd only be 351. So he's taken an opportunity cost risk of $67,000. Right? Now, are there other risks that are factored into this? Well, we can go back to the beginning. Creditor default risk. Is he really at risk of defaulting on the house? Well, no, not really. Because let's say he can't pay the money all of a sudden, he still has the $100,000 invested. He can take that out and pay it. So he's not really at any creditor default risk. Country risk, business risk, foreign exchange, interest rate risk. No, not really. It's a mortgage. They're backed by the federal government. Political risk. No, not really. Counterparty risk. Nope. The bank's not going to renege on the contract. With liquidity risk. No. So I'm not sure what risk he's taking by just paying the mortgage monthly, as opposed to paying it off all at once. I'm not sure what risk he's taking there. The risk seems to be the opportunity cost risk of not investing the money, because he's lost all that extra money. Now you got to factor this in. If we're talking about a guy who's retiring in the next 10 to 15, 20 years, he's lost all of that money that could save him in retirement or be a big benefit in retirement. Right? So he's giving up a lot. So he's got a lot of opportunity cost risk. What's the risk of, so if he pays off the house, though, he doesn't have that money anymore. And let's say the house doesn't grow in value, or it goes down in value. And let's say he has to go underwater in the house and sell it at a loss. There's risk there. The risk of investing it is the market could go down and he could lose money. But as we've seen from earlier with the random walk scenario, 15 years, the odds the market's going to go down for 15 years are almost zero. I mean, it's very rare. Not since the Great Depression. And even that wasn't 15 years. So would Dave sit there and go, well, they're not calculating risk? Well, it's like, Dave, what's the risk they're not calculating? I don't see it. Because I'm calculating that he's taking more risk by paying off the house now.
Misuse of the concept, really. Now, I do have to say, I think the decision on this is really individualized.
Sure.
Based on what the person's goals might be. I agree that it's fully misrepresenting the idea of risk, just the way he's, stating that. With this particular guy, you can tell he obviously he wants to pay off his house. He just wants to own that thing outright, and that's his value, and it's his prerogative, and he should absolutely do that. But risk isn't necessarily what this is about.
Right, which is why I agree with what he said in the beginning, what his financial planner told him, his financial advisor told him. You could pay it off now, or you could invest it. His financial planner didn't say, you should do this. He said, these are your options.
Yeah, that's fair.
Dave wouldn't interpret it as this guy had some sinister motive. No, the guy said...
What it boils down to is it kind of boils down to, is this man's goal more in alignment with wanting to have less payments in his life? He really just doesn't want to have payments for things. He wants his cost of living to be extremely small and, something in that category? Or is his priority in building wealth and making the money grow upward? And there is nothing wrong with either one of those, but they're different goals and might translate into doing different things.
I agree. In my calculation, and if it were my client, I would have said pretty much the same thing his financial advisor said, which is, yeah, you could pay it off, you could invest it, and it could grow. I can run the numbers and show you what it would look like projection-wise. Neither one of them are going to be perfect. I can't predict the future, but either way, there is an opportunity loss, especially by not investing. But if you feel better just getting rid of it, I don't really care. It's not my money; it's your money. My argument on the intellectual side of this would be, look, if it's going to cause the guy stress, it's going to deteriorate from his quality of life to have the debt on the house or have the mortgage. I mean, frankly, that's all in his mind, right? That whole
he's got to live in his mind. So.
Right, I know, but if that's what he wants to do, that's fine. But that's all in his mind, right? In reality, the smart move would just be to pay the mortgage and invest the money. That would be the smart move in reality. But that doesn't necessarily mean we're dealing with somebody who's acting completely in reality. If for him that's just too stressful to handle and he can't wrap his head around it, then fine. Let's just pay off the house. I don't care.
Well, I'm not going to lie. If for me, I'd pay off my house too.
Yeah, but
that would be more in alignment with my current goals and priorities. So
yeah, but once again, you'd have to acknowledge that the smarter, less risky move, intellectually, I mean, just factually, would be to invest the money. That would have been the actual less risky move in reality.
Yeah.
But if you don't feel comfortable doing that, then it's your money. Right.
But that doesn't have to be the thing somebody bases their decision on.
No, that's what the whole, you're calculating it in your heart thing. And it's like, okay, I was making fun of that. But the reality is to a degree, I mean, if you're going to do that, that's fine. But my position is always going to be, let me at least explain to you why that's not the smart move. I don't want you to go into this completely ill-informed. I would like you to at least know that the smart move would be to...
I push back on this is not the smart move, because the smart move is the one that you are most comfortable living with.
No, I'm talking about financially. Just financially, not...
You're talking literally numerically.
Right. I'm your financial advisor. I'm not your therapist. It's not my job to make you feel ultra comfortable about everything. My job is to give you the options and do the one you decide.
They're probably not going to be terribly interested in doing something they're not comfortable with.
Right, but my point is, I'm just giving you the options. Right?
That's good. Yeah.
Yeah, I'm not here to make the decision.
Options that conceivably make sense.
Right. This is why I hate the whole 7-point plan shit that Dave has and all these other guys. I'm not here to tell you what to do, like Dave just did to that guy. I'm just here to tell you, if you do A, this is probably going to happen. If you do B, this is probably going to happen. These are the costs. These are the risks. You got to decide which one you want. Yeah. If you're going to do, the intellectually and just tangibly and factually best decision in that scenario, with the least amount of risk for the most reward, if we're just calculating it out, like we've just been doing for the last hour, is just pay off the mortgage, invest the money. That would be the most mathematically smart move to do. If the guy doesn't want to do that, it's his money, not mine.
You said pay off the mortgage and invest the money.
No, I said, yeah, pay off the mortgage over time and invest the money.
Oh, I think you didn't say over time.
Oh, well, I meant over time. Just pay off the mortgage every month, and then, yeah, that would be the smart move as far as risk return. Just if we're just calculating risk return, which is all we're doing today.
Against you're seeing an episode where Duncan and I would do different things.
Oh, yeah.
However, what I will say as the qualifier is that I wouldn't be using the technical risk. I'm not talking about Dave's risk. I'm talking like technical risk would not be the thing I would be using to make my decision. It would be more of a goal-oriented, lifestyle goal-oriented reason for the decision. But you are seeing here where Duncan and I would do different things.
Yeah.
There you go.
Well, it would also depend, too, if you had different goals. And like we did our financial planning episode, if that was not in line with your goals, then no, I wouldn't even be bringing it up.
The thing that made sense.
Right. But that's adding another factor here. I'm just talking about just the intellectual position would be that. And I bring it up and just say, hey, this is probably what it would be or that. I know it's not for your goals, but I thought I'd at least bring it up.
Mm-hmm.
You know,
right.
But I would just assume, since you just want to get rid of debt because you don't like debt, let's just do that. But that would be an easier conversation because I would already know your goals.
Right, you would already know.
Yeah. That'd be the first page of my file. Right? Well, what's Lacey's goals? Oh, yeah. Okay.
Maybe people should, loop back to that episode we did about a financial plan because, again, a good financial planner should be wanting to know about what the client's goals are, because if you had me come into your office, you would know, based on my unique circumstances, that having that payment gone is of higher value to me regardless of what it does with the other numbers.
Right. And that's the thing, is that the smart move is not always the best move for the client. Right. The thing I love about Dave is he's telling the guy what to do, and he's telling him it's not the smart move when it is the smart move. Right? And he has no consideration for the actual risk. So what if it was somebody who wanted to make the smart move and didn't care that much about the debt and listen to Dave? Well, they would have just given up $67,000 of growth, and they'd have put themselves in a position where they had less reserve cash in case they had an emergency. So they'd have put themselves at even more risk. Not just opportunity cost, but lack of liquidity risk.
Right.
So,
right.
Yeah.
I mean, that's an area to be careful, though, when you're going to be paying things off, that you don't put yourself in that particular risk.
Yeah. So I'm still the champ. Because I covered the risk. Woo! Duncan.
On that he always does, which I want to shake my finger at him. How do you forget his own advice? But
yeah. Well, but I mean, he didn't ask. I mean, it would have been one thing if I'd have asked the guy and said, "Hey, well, what do you feel like doing?" Right? Then I would have said, "Okay, this is what you're giving up, but if that's more comfortable to you, then that's more comfortable to you." But it's not the smart move. It's just what makes you feel better.
Right.
Which is fine. I mean, don't get me wrong. I've paid $500 for a pair of shoes before. It was not the smart move, but I did it.
But it was your priority.
Because I felt very comfortable doing it at the time. I felt the need. I used my heart. Actually, I didn't. They were really comfortable, so I had to go with it. So,
I mean, you know what? At least you didn't spend $500 on a pair of shoes that were not comfortable. Hello, a woman's world.
well, yeah. But see, with men's shoes too is
On that.
yeah. Well, with the cool thing with men's shoes is if you get a really nice pair of shoes, and as long as you don't scuff the crap out of them and you're careful, you can get them resoled and redone like 4 or 5 times, and it's usually like $20 to go to a cobbler. So. Anyway, financial advice. So, Lacey, where can everybody check you out since we're dragging on with meaningless talk?
Yeah, talking about shoes, people talking about shoes. So, if you want to hear me talk about my shoes, which I basically never do there, so terrible segue, you can find me at mysensewithsense.com. I am also on Twitter and Instagram, so look for Sense with Sense on both of the places. If you're interested in blog posts or courses, that is on my site. If you have questions about them, you can email them to me at our email address, or send us any of the links you want us to watch. If there are clips you want us to watch, or questions, topics you want us to address, send them in the email. And where do they get us via email?
You can email us at gossipfinancead@outlook.com. And then we might have some investment opportunities coming up next year for different portfolios if people are interested. Just simple diversified stuff, nothing crazy, but we can talk about that more later. Anyway, thanks for everybody for joining us. We hope you had fun.